again, I appreciate you mentioning the spoofing. Curious, because my understanding of how some of the manipulation has occurred is that, if silver is trading $20.05, there's a lot of stop orders placed around the $20 handle. So often if the price can get pushed a little bit, then you get a lot of those high frequency algorithms kicking in, and then you'll see a drop, with many feeling that people kind of nudging a little are then able to buy lower. Does that sound like a reasonably accurate portrayal to put it in perspective to folks, or would you phrase it differently?
Well, it's a good portrayal, but it's a very good portrayal. But it's actually also a reflection of what I was just speaking about, of how trading has changed. So even back in 2008, 9, 10, maybe a little bit of 11, even when a lot of these silver trades and some gold trades were pretty suspect when you're looking at them, you didn't have high frequency traders in these markets like you do today.
Right.
And they're still not all over them, but spoofing meant one thing when it was, an average person out there, saying they're going to sell 100 lots of something and trying to tick the price up a penny. And then once it goes up, then they offer, half a penny. Mm-hmm. If they get it to go up a penny, they offer half a penny, and they make a half a penny where they weren't going to make anything. And then they pull back those other offers for a penny, right? So they say, I'll sell these things for a penny more than anybody else is offering. And the price ticks up, and a couple of people may take advantage, but then they pull back the offer real quick. And then they say, now I'll sell it for this amount. And they get a bunch of buyers. So markets are changing. And so you have these high frequency traders who are getting into more and more areas. And at first they weren't into futures. They weren't into commodities. But now they're getting into them, particularly oil, some of the larger trader T-bills, and they're getting into gold and silver. No less so like pork bellies and live cattle and stuff. But, what they want is volume. High frequency traders, I call them cheetahs, not because they're like Boston card cheaters, but because they're fast, like the market cheetahs in the jungle. And they're trying to prey upon any little time lapse that they can see, but they got to have volume to make those changes. And they serve a purpose, the cheetahs, because they add liquidity to markets. So if there's somebody who wants to buy or sell, cheetahs will take them. They'll do it. They're just going to offload it one way or another in the meantime, and just they'll be so quick that they're trying to make just little micro pennies in nanoseconds. So the difference in your description is that today, when a market moves because of a spoof, it can move a lot more